Okay, so for this question, we're going to do consolidated statements on the date of acquisition. And the question that we're going to do is pork and barrel. And this is part 1 of 2. We're going to do 2 questions regarding consolidated statement and the date of acquisition. So the question starts with, they gave us the financial position, the balance sheet for pork and barrel as of December 31st, year 2. And we're told that pork acquired 70% of outstanding shares of barrel on December 30th, 2000 in year 2 for $2.94. So it's P purchasing B, and it's only 70% purchased. And the purchase is $294,000. And we're purchasing outstanding shares of B company. Okay? And there's a direct cost of acquisition of 12. So there's an acquisition cost, $12,000. Okay, $12,000 acquisition cost. And the book value of the net asset, approximate fair value, except for plant and equipment, which had fair value of $320,000. So there's a couple of things. So the first question says, I want you to prepare the consolidated financial statement for December 31st, year 2. And then part B says, calculate goodwill and non-controlling interest on the consolidated statement under the parent company extension theory. So let's take a look at a couple of technical materials before we start solving this question. So first of all, when we're preparing a consolidated financial statement, we're going to use the direct approach to solving this problem. Now, in your textbook, there are 2 approaches. There's a worksheet method and there's the direct approach. And it's advisable that we use the worksheet method. And the worksheet method always starts with the parent's book value plus the book value of the subsidiary plus the acquisition differential. We're going to change this up a little bit. This is different from the other questions that we've done. The difference here is that we're going to actually add the book value of the sub and any fair value differences or incremental differences of fair value and book value. We're going to highlight that separately to give us our consolidated amount. So this is an example, and it's just to show you that this is what we would expect you to do, is to show the work that you came up with the consolidated values. So the work you need to show is done in brackets by showing the book value of the parent plus the book value of the sub plus any fair value increments. Okay? So that's essentially what we're going to do on a go-forward basis. Now, a couple of things to note is at the time of the investment is made, we know that there are differences in the book value of the investment, the cost of the investment, and the underlying book value of the shareholders' equity of the company acquired. And that difference is what we call the acquisition differential, AD. Acquisition differential must be allocated to the various assets and liabilities of the acquired company, with any residual allocated to goodwill arising on consolidation. So that's what we're going to do. I want to show you in the pork and barrel question. The other thing to talk about is, remember, we bought 70%. So 30% is what we call non-controlling interest. And non-controlling interest, we're going to call NCI. Okay? So these are the group of shareholders that are what we called stakeholders in the company, but they don't control. Because remember, we bought 70%, and 70% in that, again, in that percentage of ownership means that we have control. In our handbook, the non-controlling interest has 2 options. We can either record it using the entity approach, And the other one is called the parent company extension approach. We are going to assume that we're going to do this question. We're going to use this method is used in all of the consolidated exercises in our mock. So we're going to actually use this method, but sometimes we will ask you to do this method. So our handbook allows us or provides us. So IFRS 3 provides two options. The entity approach, so option 1, and option 2. Those are the two options that we have. So let's take a look at what is the entity approach. The entity approach basically is used for any consolidation effective 2011. And it says that under the entity approach, the cost paid by the parent in the acquisition, so if I paid X amount of dollars for 70%, it's assumed to be a representative of the fair value of the entire company. So what they're saying is, the entity approach is saying that if you paid X amount of dollars for 70%, that must be the value of 70% of the company. So if we're trying to determine the value of 100% of the company, we're going to take the price paid for 70% and we're going to extrapolate to the shares not acquired to establish the fair value of the entire company. So that's essentially what we're trying to accomplish. Now, it says, as a result, the assets and liabilities, including goodwill, if we're using this method, is valued at a total fair value of the date of acquisition. Non-controlling interest is valued at fair value. So this is important because non-controlling interest is assumed that we're going to value at the fair value of the acquired company, not book value. And non-controlling interest is presented as a consolidated equity based on fair value of the subsidiary's assets and liabilities. So if you think about it, if I paid $70,000 for 70% of the company, that means the fair value of the entire company must be $100,000 because the $70,000 represents 70% ownership. If I'm going to value the business at 100% and 100,000, then effectively the non-controlling interest is also going to be valued at fair value of what I've actually paid. This is called the entity approach, and the entity approach is the one of the option if there is non-controlling interest. So this is the accounting for NCI. This is option 1. Now, option 2 says, what if we decided to do the other option? Remember, the second option is the parent company extension approach. Here's the option. The parent company extension approach addresses concern about goodwill valuation under the entity theory. Because remember, the entity theory means we're going to value the business at 100%, which means that when we calculate the goodwill, it's going to be 100% of the value of goodwill for the entire company. So what this other option says, goodwill at 100% is not reflective, because if you think about it, non-controlling interest didn't really participate in the transaction. It was only the parent at 70%. So when we're establishing goodwill, because we do a linear extrapolation of what the parent paid of its share, so it doesn't make sense. So if you think about it, does non-controlling interest really have goodwill? They didn't really participate in the transaction, and therefore there should be no goodwill. associated with a non-controlling interest. So reflects both parent and non-controlling interest share of identifiable assets at fair value. However, only parent share of subsidiaries' goodwill is reflected on the consolidated balance sheet. So what this method says is that I understand that we need to value the business at 100%, but given the fact that the goodwill is based on the parent's acquisition, it doesn't make sense that the non-controlling interest would also pick up their share of that goodwill. So what the parent company extension approach says, we will pick up, the non-controlling interest will pick up their identifiable assets and liabilities at fair value, but the goodwill amount should only be the parent's proportionate share. We're going to come back to this theory again at the end as we go through the pork and barrel question. Let's do that question together. So, first, let's analyze the purchase price. So in this case, the purchase price is the cost of 70% of B company, let's call it B for barrel, and that is $294. That's what we paid, right? The acquisition cost. Remember, the direct cost of $12,000. This is expensed. If you remember in our previous question, this is expensed, right? So we know we need to expense this amount. So we're going to take that and we're going to actually calculate the implied value. So how do we do that? We're going to take 294 divided by 70%. So that means that the implied fair value of 100% of B company. That's essentially what we're trying to calculate. Now, we're going to compare it to the book value of 100% of B company, and that is essentially 120,000 plus 80,000. This is shareholders' equity. We have $120,000, and we call that acquisition differential. Now, we are told that there was only one item that had a difference in fair value and book value, and that is property, plant, and equipment. So we're going to allocate that to identifiable assets, so property, plant, and equipment. I always show the fair value less book value. So this is fair value less book value to give me 50,000. So think about it, you guys. I paid $294 for the business, and there's a reason why I paid more for the identifiable asset. So that $294 at 70% translates to the value of the business of $420. I compare it against the book value, and I get this what we call acquisition differential. I need to analyze why I paid that difference. And that difference is based on any fair value increments of identifiable assets. There could be some intangible assets that are not recorded. And of course, the difference goes to goodwill. In this case, the reason why I paid $120,000 more was because the value of the property, plant, and equipment was much higher than what the book value showed. And the difference goes to goodwill. Now, this will be amortized. Over the remaining life. So we're going to actually, in future questions, we're going to actually take this acquisition differential of 50 and we're going to amortize this over the remaining life of the of the property, plant, and equipment. In addition, we're also going to test this for impairment in future years. Okay? So now let's do the consolidated statement. So part A says, prepare a consolidated statement of financial position, assuming we're going to use the entity method. So we've got pork company, consolidated balance sheet as at December 31st, year 2. I'm going to start with the first, the item that they gave you is property, plant, and equipment. Again, I always start with P company's book value plus B's company's book value plus fair value increments. So we're going to start with B. So book value of B company plus fair book value, of, that's not, so this is P, pork, and this is barrel, plus fair value increments. Okay? So if you remember what we started with originally, that's what we're trying to do. We're trying to use a direct approach where we show first the book value, and then we're going to add the book value in the sub, and then we're going to actually add the acquisition differential. The reason why I like to show, I like to use this method is because when I do a question and perhaps you can't balance, let's say you have an issue of balancing your consolidated balance sheet, your income statement, you can easily find your errors knowing that you had a kind of an approach in providing how you accumulate your numbers. Now, next is goodwill. And goodwill, we know we calculate that to be $70,000. Inventory, there were no fair value increments, so we're just going to add the 120 plus the 102. Accounts receivable, again, the same idea. We're going to add the 80,000 and the 48,000. These are just book value of P, pork, and book value of barrel. And then cash. And this is 101,222,000. Now, in terms of the other side, we've got common shares. And this is always porks. Okay, so 260. And retained earnings, because it's the date of acquisition. And that would be 200,000. We've got non-controlling interest, and this one is 100% of fair value. And in this case, the fair value of the implied value of the business was 420. Remember we saw this? That was the 420. And I'm going to show 30% of that as the value of the non-controlling interest. Remember, this goodwill is also 100% of the entire B barrels companies, right? So that would be the entire 100%. This is called the entity method. And of course, you got long-term debt is 240 plus 108. And then current liabilities, 216 plus 72. So this is called the entity approach. The entity approach requires us to record 100% of the calculated goodwill, and also requires us to record 100% of the non-controlling interest share of fair value of the net asset plus the fair value of goodwill. So this is this represents, if you really think about this, this represents fair value of net assets plus goodwill. Now, Part B says what would be the goodwill and non-controlling interest assuming we use the parent company extension approach. So this is the second method. So using the parent company extension approach, what would be the goodwill and the non-controlling interest? So this is asking us the other method that's allowed under IFRS 3, and this is only because of the non-controlling interest. So goodwill, so GW under the entity method is 82,000, right? No, 70,000, sorry. So that 70,000 is this number here. So I'm just giving you the roundabout way of doing that. Okay. Now we're going to take away less the NCI of 30 because the assumption here, the parent company extension approach assumes that the goodwill arising from the acquisition is really only the parent. It's only really Pork's portion, not the non-controlling interest. So we're going to take away 30% of that to give us the goodwill under the parent company extension approach. Okay? Now, the non-controlling interest at 100% is this number, wasn't it? 126, right? And that's this number here. Now, remember, under the parent company extension approach, we should only be reflecting non-controlling interest should only be their proportionate share of the net asset. So in this case, we're going to subtract the goodwill. Less NCI's goodwill portion, right? And that's this number here. So this will be the NCI under parent company extension approach. Okay, so there are basically two methods that the standard allows us to use. The two methods are the parent company extension approach and the entity approach. These are allowed under IFRS in recording non-controlling interest. And there are two different philosophies. One philosophy says that we want to show the non-controlling interest, their proportionate share of the value of the entire business, which would include goodwill. And the parent company's extension approach says goodwill should be excluded because goodwill is only, the reason why you have goodwill is because you paid more for what the business currently is valued today. And that's because the reason why you pay more is because you think there has future income potential. And that really only relates to the parent, the acquirer, which in this case is Pork's portion. And that's why the goodwill amount is excluded from both the goodwill amount under the entity, from the parent company extension approach. So the only difference here is these two amounts. And that's going to be adjusted, reducing the goodwill related to the non-controlling interest. Okay, thank you.